Hey guys, hope you are all having a great day today. We had a bit of a reversal today, with both stocks underperforming and eating away much of the progress that we made yesterday. However, even on red days such as today, my faith on the squeeze strengthens. There were a variety of small changes, almost insignificant data coming out that suggests something is not right, especially when compared against the price action we experienced today. We always talk about how the price is an illusion to scare paper hands into panic selling, and I still stand by that, which is the reason why looking at the price performance of these stocks as a way to measure progress is such a big mistake that I still see people repeatedly make. As such, today's video is going to be focused on a small but important variety of updates and evidence that go to show what exactly is happening with GameStop and AMC at the moment. I also want to revert back and quickly discuss some things regarding the DTCC new rulings based on some of the comments and concerns I saw on the video I released yesterday. As such, expect today's video to be incredibly motivational, but even more than that, it will be very insightful and educational for many. I urge you to please remember to drop a like on the video if you liked it and found it somewhat helpful or constructive. Keep in mind all things discussed on the video are subject to my own interpretation and opinions and that I am not a financial advisor. I simply look into the matter at hand as much as I can in order to properly inform you as best as I can. Without further delay, let's simply dive right into today's segment. One of the things that I noticed along with many others was that GameStop began to gap throughout the day. This is a phenomenon that occurs every time a stock gets relative low volume. With such low volume, the price experiences a wider spread, allowing for price changes to be more dramatic. Now let's break this down a little better. We know a transaction occurs between two parties, the one offering a bid to purchase and the other offering an ask to sell it. When a stock has such low volumes like GameStop had today, this would inevitably impose a bit of an increased risk for the ones doing the selling, in this case market makers such as Citadel. The risk comes in probability, as the opportunity to decrease the price by selling is lessened. As such, there is a higher chance that on a big enough dip, GameStop could have one of those fantastic rebounds it often has that come out of nowhere and they are left holding more short positions at a loss. Now, let's bring it back to what happened today. We saw GameStop having a pretty low volume today, and that presents a risk scenario for hedge funds and market makers that short the stock. As a result, they start widening the spread as discussed a minute ago, in order to hedge form of the risk that was birthed by the low volume today. A lot of people online started talking about how little liquidity there was today, and spreads were not being filled as they normally have been for months. What this means is that there was low supply for a high demand. On a practical scenario in another dimension where the SEC does their job and the markets worked aligned with the laws and regulations, the normal response to this would be the price of GameStop blowing up. Guys, this is simple economics 101. What happens when the demand for a product is much higher than the supply of it? You will see the price of such product increase dramatically to the point where the demand for it lowers. Ignoring the manipulation and other reasons for why the stock continued to magically fall today, GameStop would have had an enormous jump today. These clowns can barely even keep things working as an apparition. Now, I can already hear thousands of you typing the follow-up questions, so let me address it real quick. Yes, people are selling. This does not mean that people have suddenly stopped buying GME shares. What this means is that they are routing so many orders through dark pools that it is now having a weird effect, a weird performance on the price. Remember what we talked about last week, guys. Hedge funds are placing buy orders in blocks that they then route to dark pools. They process all these purchase orders as a single order as a way to combat the bullish pressure that would otherwise cause the stock price to move up. Now, the second thing I wanted to discuss comes directly from a user named Diamonds or Forever. He made a post that really goes to show much of what we have been discussing on this channel. He posted an image that contains and compares monthly inflation numbers for the past 20 years. He highlighted inflation numbers above 5%, which when look and compare, it shows that our current levels match up with some of the numbers we saw back in 2008 when we had our last economic recession. Just wanted to show this to you guys, as it further illustrates the current economic climate we are living in, and why the DTCC is making quick and frantic rulings to protect the markets from the crash we will certainly experience if inflation and other economic factors don't start seeing recovery relatively soon. Now, let us address some of the concerns and questions I saw regarding the new DTCC rulings. Again, let's quickly sum up what happened. The DTCC is intending on avoiding the massive sale that would occur from defaulting members when they find it impossible to keep delaying the squeeze. Once the domino effect starts taking place, everyone is going to be falling. As such, the DTCC wants to prevent a massive market crash that would follow inevitably. Remember, when these hedge funds and banks and everyone involved that got overexposed starts getting their assets and securities liquidated, everything they hold was going to be sold off. Millions of blue-chip stocks all the way to risky investments were going to be sold off on a rapid sale to pay off for the squeeze. It takes no big brain to imagine and know that this scenario would essentially crash everything, which would result in a serious challenge and problem for the DTCC in the future. As such, they have devised a way through which the initial sell-off can be managed so as to not cause a market crash. They will have defaulting members simply loan out their shares for cash to meet collateral requirements. They simply lend the DTCC their shares and for money in order to pay for your Lambos. Remember, this does not prevent the squeeze as many have been screaming out of anxiety. The squeeze is inevitable. What this changes is perhaps the time frame by which the squeeze takes place, or in simpler words, it could hypothetically make it a longer process, but your tendies will be served. The DTCC aims to control the outcome effect of the squeeze itself, as they are planting ruling precisely to protect the market from a collapse or market crash. They want the markets to be as immune to the effects of such a big squeeze as much as possible so as to keep business afloat and keep making money. A lot of people are misinforming others on social media, so be careful who you listen to and be sure to correct them. The DTCC is simply trying to control the outcome of the squeeze, which would have been a sudden and predictable market crash upon default of the hedge funds. Instead, the new process lays out a blueprint by which the effects of the squeeze on the markets can be minimized or better controlled so as to not destroy everything. However, there are no guarantees as to what exactly will happen and how things will go down. There are other variables at play that could indeed still cause a global financial collapse. We aren't taking into account foreign markets and how they would react to this. Much is in the line right now, and no one can predictably quantify how everything will fall correctly. As such, try to keep things simple. Buy and hold the stock. Know that the DTCC essentially confirmed the squeeze with these last rulings. Know that the squeeze price will be life-changing and that these new rulings don't control or affect the squeeze price that your GME and AMC shares will have. Instead, they simply aim to control the market outcome of that event. The Fed engaged in reverse repo operations resulting in over $927 billion. We finally did it, guys. We overcame the 900 mark and are a hair away from hitting $1 trillion in reverse repo operations. Dark pool transactions for AMC accounted for 70% of the total volume, while GameStop's dark pool transactions account for 43% of the total volume today. According to Fidelity's data, AMC's buy order flow doubled the sell order flow, and GameStop had almost 4 times the amount of buy orders than sell orders. Let us now wrap up the video with some technical analysis. AMC had a pretty red day, undoing much of the progress it had built yesterday. The stock had a pretty stable pre-market, reaching 40.94 and maintaining support right below the VWAP for most of those early hours. Upon market opening, the stock had a pretty brutal fall, and eventually bounced up from the lower band of VWAP. The stock then quickly entered into a descending triangle, where it would eventually break support. The stock then once again touched and bounced back from the lower band of VWAP. It broke some small resistance lines at 37.75 and ran to challenge the VWAP again. The stock closed at 38.01, well below the VWAP line. It appears hedge funds might be intending on having the stop close below 35 by Friday. Great job everyone who keeps holding and buying these dips. Though we retraced today, it has given the ample opportunity for many to buy more at a cheaper price, so that is always good. GameStop on the other hand had a less volatile retracement today. The stock simply had lower highs and lower lows throughout the day. Not much to talk about since the pattern repeated itself for literally almost the entire day. The stock had a small rebound around 2 p.m. where it tested the VWAP line again but failed to build on top of it. It eventually closed at 178.54, well below the VWAP. I am super bullish about GameStop and encourage people to try to grab a few shares if you can. I know it is the less popular and more expensive one, making it a bit less appealing, but I personally think a small balance in portfolios between these stocks would be practical to really maximize your probability of making the most amount of money. Either way, buy whatever you feel comfortable with and hold to the moon. Let me know in the comments if you enjoyed this video. Let me know how you feel about today's price performance and if you plan on buying more stocks this week or waiting to see if the stocks move even lower. Drop a like on the video, and a big shout out to Patreons. People that donate to this channel either through a Patreon pledge or single-time donation are the reason for the existence of this channel. YouTube pays me like hedge funds will pay in bonuses this year, due to me being automated. Thank you for your hard contributions and consideration for this channel. As always, don't forget to subscribe if you like the channel and you are new here, and I will see you on the next one. To the moon.